Hey guys, I just want to give you a quick update about what's going on and how I feel about the market, and maybe you can make up your own opinion. And please let me know in the comments. So let's dive into it. First of all, I just want to disclose my own position. So I bought on Monday. I bought 150 shares Lemonade at 26.67. Yesterday I bought 100 shares at 28.13. And today I bought 95 shares at 31.96. So in total my position is now 557 shares at approximately $37, which is exactly $36.97 and 7 whatever. Also I have Tesla calls, and I have Lemonade calls, which I'm not going to talk about here today. I don't feel confident enough to disclose this. But yeah, so that's my entire portfolio consists of Lemonade, Tesla calls, and Lemonade calls. Okay, so first of all, there are some crazy observations in the market currently, or at least that's how I feel about it. Lemonade, including Metromile, has a market cap of about $2 billion. It depends what price you exactly look at, but as of yesterday and on Monday, it was 2 billion or even lower. These two companies combined have 1.3 billion cash on hands. So basically you could say their business is valued at something like 700 million. Not exactly, but we would need to include the liabilities. But 700 million for this business seems to quite a good deal to me. Also, they have equity of about 1.2 billion, which results in a price to book ratio of lower than 2. They grow at 80 to 90%, depends what year exactly or what quarter you'd look at. It also depends if you look at in-force premium or revenue, but I would say in-force premium is the more consistent metrics to look at, and they do quite a good job at 80% growth rate. Also, I did a discounted cash flow, and I made some conservative assumptions. And based on my discounted cash flow analysis, this business should be valued at more than 10 billion. I'm not saying that we should value this business at this price. That's just what, in a good future, this is how this business could be valued, or that's at least how I look at it. Also, they are a full stack insurer. They are #1 brand. I mean, I follow them on Twitter, and sometimes I just read how people write about Lemonade. They are super excited and so happy to be customers of this brand. Also, I made a video about their autonomous organization, how they think about their organization. So yeah, think about that. We buy all this for $2 billion and also 1.3 billion cash. And 2022, my estimated in-force premium is about 1 billion. It's probably about 850 million, but in a best case scenario, at the high end of my estimations, they could hit 1 billion in in-force premium if really everything goes really well. I hope so. So, 1 billion in in-force premium, and I'm buying the company at 2 billion. They grow at 80 to 90%. They have more than 1 billion cash on hands. I like Lemonade at this. I really like Lemonade at this price point. Okay, next crazy observation: Square, or Block now. Their revenue is about 17 billion and their price to sales ratio is about 3.1, compared to JP Morgan, which grows a little bit slower. They are valued at 3.5 price to sales ratio. Teladoc revenue is about 2 billion, which results in a price to sales ratio of 6 approximately. These are all approximate numbers because it's just to have a quick look at the numbers. Zillow, their revenue is about 6 billion and price to sales ratio is about 2.1. I know they had some difficulty because they quit one division they had. So next crazy observation: high growth stocks lost up to 80% of their market value since, I believe, February 2021, which was very optimistic. So let's look. Lemonade lost about 80% approximately, Zoom 74, Zillow 75, Teladoc 75, Coinbase about 45, Snowflake about 30, Snapchat lost about 63, Airbnb lost about 30, SoFi about 50, Robinhood about 81, the entire ARK Invest fund, the ARK-K, lost about 53%, and the ARK Genomic fund lost about 56%. And at the same time, the S&P 500 went up 12% since February 2021, and the Nasdaq went up 4.5% since February 2021. So other indicators are that I already see these doom and gloom prophecies on YouTube that we are going down to, I don't know, a couple dollars, the entire stock market is going to collapse. Also, I heard that some guys sold their entire portfolio. Dave Lee did an interview about that, quite interesting. Then correction due to increase in interest rate. I calculated that and it should be about 10 to 15%. That's the episode I did yesterday. I did publish yesterday with the Excel sheet. Make sure to download it, play around, and look at what correction we should expect for an increase in interest rates. The forward PE for the S&P 500 is about 19, which seems quite cheap to me, especially considering that, you know, Apple, Microsoft, Alphabet, Tesla, Amazon make about 25 to 30% of the entire index, and they of course have higher PE ratios. So it seems quite cheap to me. Then some stocks trade at summer 2018 levels. In my mind, I'm thinking of Netflix. I also believe Zillow is on the same spot, and Square, I believe. I'm not so sure. So these companies are trading at levels that are 3.5 years ago, but you know, there was a pandemic in the last 2 years, and these businesses for sure did benefit from this pandemic. Traditional stocks seem at a fair price, and traditional, you know, stocks which I wouldn't buy. 3M has a PE ratio of 17, a price to sales ratio of 2.8. Now, just put this in context. 3M price to sales ratio of 2.8, and we can now buy Zillow at the price to sales ratio of 2.1, or we can buy Square at a price ratio of 3.1. And General Electric has a price to sales ratio of about 1.2. There are a bunch of other examples I could choose, but it's just to illustrate my point. My thoughts are that in greedy times, valuations are based on discounted cash flow models, which reflect the future cash flows. In normal times, I would say valuations are based on ratios, considering especially earnings and sales of the last year, last quarter, or estimations for this year or the next quarter or whatever. And in fearful times, I would call it like that, valuations are based on balance sheet. So then people start to look at price to book ratio, cash on hand, and how high the liabilities are, and so on. And I would say we are, from the valuation standpoint, looking at cash flow analysis, stocks seem to me extremely cheap. Looking at ratios, stocks seem fair to cheap, more cheap than fair. And looking at balance sheet valuations, so, you know, price to book or so, stocks look fair. Maybe not pricey, but a little bit more than really fearful times. Okay, so to sum up, I would say that my feeling is the market is overreacting. This is not financial advice, of course. I feel the market is overreacting. Some people are even panicking. Doom and gloom prophecies, people selling out their entire portfolio. Yesterday, I don't know if you observed, after hours, Microsoft released their earnings, and they were quite good. They did beat analyst estimations, but the stock went down anyway. Yeah, so today it looks a little bit better, and let's see what we see this afternoon or this evening with Tesla earnings and the Fed. I'm very optimistic, and I believe that tomorrow the stock market could be green again. I hope so. Let's see. Anyway, let me know in the comments how you think about all this. How do you think about valuation in good times, in normal times, and in fearful times? And what are you doing now? Are you buying? Are you selling? Are you buying calls, selling puts? Or let me just know what you're doing. I'm curious, only if you like, of course. Also, make sure to follow me on Twitter. It's Karim Hateke. I will post it in the description down below. So have a nice day and see you next time. Bye.